Hello and welcome along to the next part of the course. So here we're going to be focusing on the real world industry for this particular pre-scene case. We're going to be looking at the luxury bag industry, all from all aspects and all perspectives in terms of both manufacturing and the sales side of things. We're going to be breaking it down into different sections and focusing on broad industry trends and then getting more and more precise and detailed by looking at consumer behavior and consumer feedback, and then looking at the specific problems, opportunities, threats that face companies within this real-world industry, and drawing out some of the implications for the particular company that we're dealing with here, Mansako, in this pre-scene. So before we get into the details, let me give you a quick overview of what we'll be covering in this industry analysis. First, we're going to look at macro trends. And we're going to be focusing primarily on quantitative side of things in this section. We'll be looking at the personal luxury industry growth in recent years, and we will also be looking at some projections into the next 5 or 6 years. From there, then we'll move into qualitative analysis. We'll be looking in particular at consumer behaviors, the psychology of consumers in this particular segment. Then in the third section, we'll move into the issue of accessible luxury. This is a really important feature of the pre-scene and the Mansako case. We're going to be looking at some of the dilemmas and challenges that face companies within this particular sector. Really, really interesting, this part. We're going to spend a lot of time on the strategic challenges that face accessible luxury companies and how they can deal with these in various ways and what the future might hold for real-world examples of accessible luxury companies. And this then will help us to understand better the pre-scene case and the particular circumstances faced by Mansako. From there, we are going to look at costs, particularly in this industry. Costs are important and especially challenging, I think, for various reasons, which we'll go into. That also has implications then for pricing and in turn for product positioning, which is a really important strategic consideration. And finally, then we'll move on to considerations of opportunities and threats within this industry in terms of things like diversification, the online trends, discounts, and, as I said, positioning, a really important feature of the accessible luxury market in particular. Overall, this is a really interesting analysis and actually a very interesting case, I think. It's got a lot of really interesting strategic angles and perspectives and possibilities in terms of how a company might move into the future, especially in the kind of medium term, next 5 years or so. We're looking at a lot of really interesting and big changes within the industry, especially at the sales end and the distribution channels end of things. Okay, so let's start with the macro trends that I mentioned earlier. So here we have an analysis which goes back approximately 20 years, a really good breakdown here from Bain & Company. We'll be relying on some of their analysis going forward in this industry analysis. They've done some really, really good research on this particular market. So as you can see here, they've said that after a brief stagnation in 2016, it looks like in 2017 there's been something of a rebound in the personal luxury goods industry. Now, we're starting with the broad personal luxury goods industry because, of course, the luxury bags segment falls within that broad industry, and so it's important to look at the overall trends within the industry and then to focus more in a more fine-tuned way on the luxury bag segment, which is what we'll be doing in this industry analysis. But we want to start out as broad as possible and then work our way in to the specifics of the luxury bag case. So you can see here we've got this graph that's been made by Bain & Company, and it's broken down into different sections. You can see here in terms that correspond to different phases in the last 20 years. Democratization from 2000 until around 2007, and we can see here there was pretty steady growth in this period. But then, of course, the crisis hit in terms of the global financial crisis, and so obviously the luxury goods sector was hit hard by that, as was almost every other sector because of how deep that crisis was. And then the recovery from 2010 to 2014 was primarily spurred on by the rapid growth of the Chinese economy in that period, and that really, really helped to cushion the blow from the financial crisis in the late 2000s going into 2010. And that's been sustained ever since, that growth globally. As I said, primarily based on Chinese growth, but Europe and the United States have recovered somewhat. And as you can see, from 2015 to 2016, a slight slump there, but by all accounts, we're seeing a return now to what the industry experts call a new normal. We're going to see more steady growth again. China has slowed down somewhat, but this has been cushioned by the resurgence of the traditional mature markets of Europe and the United States. Despite some political volatility in recent months, of course, there is a general upward trend, a growth trend in terms of the United States and Europe, as we'll see. So you can see here, just in terms of the Chinese factor, China was a clear top performer over the last 10 years or so, and in 2017 there was this, as I said, this rebound in Chinese consumption, fueled by renewed consumer confidence and the rapid emergence of a new and increasingly fashion-savvy middle class, which has been the story of the last 5 to 6 years in China. Local buying by Chinese customers boosted sales in mainland China by a remarkable 15% at current exchange rates to a total market size of 20 billion. So a very significant market there overall in absolute terms and in relative terms. You can see here again the Chinese rebound in visual representation. In 2017, it has grown again after a slight contraction in 2016. So that's good news, of course, for luxury goods, personal luxury goods manufacturers, that they can trust that China is going to return to a growth trend in the coming years. And it's such a huge market that is really, really important. You can see there Chinese consumers accelerated their buying, accounting for 32% of global purchases by value, up 2 percentage points from 2016. So a huge market there, and that's really, really important, especially for companies that are looking to perhaps expand abroad, who may not have done so yet. China is obviously a really important consideration. Now we're looking at regional sales here, the breakdown, and perhaps surprisingly, Europe has really been strong in the last year, and it looks like that might continue into the next 4 to 5 years. Bounced back after a bit of a slump in the last 2 years in relative terms, growing by 6% at current exchange rates to reach 87 billion in sales and regain its place as the top region for luxury sales by value. And as we'll see, many of the really major labels in the luxury sector in general, but also and especially in the bags, luxury bag manufacturing, are based in Europe, especially in France and Italy. And that's where a lot of the value is created in the European market. Now, in terms of profitability, this is a slightly different story. The revenue growth has been fairly positive over the last 7 to 8 years. But the profitability angle tells a little bit of a different story. As you can see here, in the past 3 years, many brands have grown in terms of revenue. You can see their percentage of winners was 65%. But when it came to actual profitability, you can see here on the right in this graph that there was only 35% of the companies in this personal luxury goods industry reporting profits. So profit making is a tricky business here, and we'll see the reasons later on. Has a lot to do with cost control and the labor costs and the intensive labor that often goes into luxury goods, personal luxury goods in particular. Very painstaking, laborious, and indeed costly process in terms of materials going into it. So that's always going to be a tricky business. And when you take into account issues pertaining to oversaturation and striking a balance in terms of maintaining scarcity and exclusivity, profitability in this segment in the personal luxury goods industry really is a very, very tricky balance to strike. So a very interesting question from a strategic point of view, as we'll see later on. Now, I want to look at the sales channels. This is a really important side of this industry, perhaps the most important in terms of strategy going forward in the next 5 years. So online sales have continued their relentless climb. There's been a really, really steady, in fact, there's almost been an exponential growth in terms of the share of sales that have taken place through this channel, the online channel, in the last 10 to 15 years, increasing by 24% in 2017. The Americas markets make up close to half of global online luxury sales, perhaps not surprisingly, with the United States leading the way, which totaled 23 billion euros, but growth was particularly strong as well in Europe and Asia. Accessories, this is really important. This is the segment within which handbags and bags in general fall in the luxury segment, remain the top category sold online, ahead of apparel. Okay, so that's going to be really important for a company like Mansako, of course, because they are in the handbag sector, and online sales are becoming increasingly important, and there's almost exponential growth, as I mentioned there, so that looks set to continue. And the trick is for luxury companies, as we'll see later on, how to strike that balance between modernizing their sales channels and retaining their tradition and their heritage. So you can see here in the figure 11 on the right hand side, the online is most prominent in the Americas, as was mentioned, but it's really becoming prominent all over the world, and Europe and Asia are catching up as well. In terms of projections, this is really important. You can see this is Bain & Company's projection to 2025. And based on the almost exponential growth that's been taking place, they're saying an at least 25% share of sales going to online by 2025. That's quite a significant share of the overall market, 25% online versus 75% in physical stores by 2025, currently at 9%. So significant growth there over the next 10 years or so. So companies really have to be attentive to this in the luxury goods segment, and we'll see what that implies then for a company like Mansako later on. So online, 9%, 25%, really, really big jump there in the next 10 years. Now, wholesale channels, this is something that is interesting to note. According to Bain's analysis, wholesale remains the largest channel for luxury goods, accounting for roughly 2/3 of all sales. However, the retail channel continued growing steadily, gaining 8% in 2017 alone, as companies are increasingly seeking to control the experience they deliver to customers. And so, even though wholesale grew, it grew by only 3%. And this is a lot to do with specialty stores becoming a more important sales channel for luxury goods producers. As we'll see later on, customizing and modernizing and updating the store, a physical store experience, is something that's really, really important, especially amongst millennial purchasers, as we'll see. And so the wholesale suffered in relative terms at least, and that's indicative, I think, of a very important changing trend, which we'll look into in more detail. Now, as I mentioned, physical store innovation is something that is really important in terms of macro trends in this industry. We'll come back to this in more detail in the final sections, but it is worth noting that the remarkable growth of the online channel, as is seen here, and the role of physical stores will need to change as a result of this shift to the online. We'll come back to the idea of omni-channel marketing. This is something that's very important in terms of integrating the different sales channels in a way that really, really speaks to the kind of the new emerging luxury goods shoppers from the millennial generation. So words like distinctive, immersive experiences, these are becoming buzzwords within the industry in terms of what industry experts say is going to be needed and required over the next 5 to 10 years. So let's look at some projections in more general terms, quantitative projections. For 2020, we're looking at 4 to 5% growth per year, according to Bain's analysis. So you can see here compound annual growth rate from 2017 to 2020 of 4 to 5%. So we're looking at fairly modest growth, not spectacular, but steady. And it seems to be tracking more or less global economic growth in this case. So something, it's kind of in the middle, neither very optimistic nor pessimistic in this market in terms of projections. Let's look at the product sector profiles here. This gives a nice insight into the various aspects of the personal luxury goods industry. It's broken down here into apparel and footwear, bags and accessories, cosmetics and fragrances, jewelry and watches, and then multiple luxury goods. An important point here to note is that in terms of sales growth, this is from 2016, we're looking at 13.4% for bags and accessories, and that is something that was noted in the pre-scene as well, that the growth figures in recent years for the bags and accessories sector and segment of the personal luxury goods industry has been very impressive compared to some of the other segments. You can see, for example, cosmetics and fragrances and jewelry and watches, much more modest numbers being registered there in terms of sales growth. So that's a good news for bags and accessories, but of course it's not the whole story. Sales isn't the only important consideration. Profitability, as was mentioned, is something very important too. So we'll come back to that and figure out maybe some different strategies that might increase those margins. Again, we're looking at a breakdown by sector, bags and accessories. You can see here the third from the left. And looking at the luxury goods sales growth and sales in terms of compound annual growth rate, very strong figures registered for bags and accessories. But in the middle there, you can see net profit margins and return on assets. These are very important measures as well, and much more modest returns there for that particular sector compared to something like, say, cosmetics and fragrances. That has a lot to do with the costs involved and the materials and the expense. In terms of the cosmetics and fragrances, of course, in general, the ingredients and the materials going in are much less costly and expensive and much easier to scale, as well as labor inputs being much less important in that particular sector. So that's perhaps not surprising in the bags and accessories segment, as we'll see that the return on assets and the net profit margins are relatively modest overall. Now we want to move on to the qualitative analysis here. We're going to be focusing primarily on consumers in terms of their experiences, their opinions, and their feedback, and what kind of drives their purchasing decisions in this luxury goods sector. So here you can see on the right, this is from a survey that was performed by Deloitte. A very, very nice breakdown here of different reasons and the weightings that customers gave to them in terms of agreement or disagreement. The top ranking responses here, you can see the first three, the most important factors that influence purchase decisions in the personal luxury goods sector. Well, first was, I buy luxury products because they are premium quality products, and this was 88% of respondents agreed with this particular statement. So premium quality, a key consideration. Then 82% in second place was, when I buy a luxury product, I feel happy and or confident. So the feeling or the experience that a user has or a consumer has is also very, very important. Not just the sense that these are quality products, but also the way that they make the person feel. This might be tied in with status or with a sense of achievement or something like that, or rewarding oneself with these luxury items. And then finally, in number three, the top three, to finish out the top three, I like to buy luxury products which are handmade. This is actually a very, very important consideration. We're going to come back to this and the implications of this for a company like Mansako later on. Let's look now at demographics. You can see here some very important demographic insights broken down in terms of generational differences and purchasing patterns. This particular analysis looks at how many of the consumers' luxury products purchases took place in a physical store, online from a laptop or computer, or online on a mobile device. Perhaps unsurprisingly, millennials were the most engaged in terms of purchasing online, either from a computer or laptop or from a mobile device, and baby boomers were, of course, the least likely to do so. But based on the year-on-year trends, each of these segments is becoming more and more likely to purchase online, as was indicated earlier. And you can see then as well, we also have a nice geographical breakdown in terms of distinctions between emerging markets and mature markets and their likelihood to engage in online purchases. It may surprise you to note there that it is in fact the emerging markets that are more frequently purchasing through online channels. And that actually has a lot to do with the price differentials, which we're going to look at in a few moments. That explains this pattern because one might expect, it's a little bit counterintuitive, one might expect that actually the mature markets, the more industrialized economies, will be the ones where online purchases are much more frequent and common. But for various reasons, which we'll look into in the next few slides, actually it is the emerging markets that are primarily purchasing through mobile devices and online. So as you can see here on the left, the millennials are the most digitally influenced luxury consumers, with 42% of their purchases made either by computer or via mobile devices. The figure for millennials compares with 35% for a Generation X, who would have become adults during the late 80s, early 90s, and 28% then for the baby boomers. So purchase locations, another important consideration. we can see here, we've broken it down in the last 12 months, how many of your luxury products purchases took place in your home country, abroad, or at an airport while traveling. Almost half of luxury purchases are made by consumers who are traveling, either in a foreign market, which is 31%, or while at the airport, which is 16%. This proportion, interestingly, rises to 60% among consumers from emerging markets, who typically do not have access to the same range of products and brands that can be found in more mature markets. So the more recent trends and the variety of trends is much higher in the more established mature markets, and that's why you see a lot of kind of consumer tourism in this particular segment. We'll also see in terms of price differentials and markups and tariffs that are placed, and premiums that are placed on imports of luxury goods in emerging markets. This is another reason and motivation for this kind of pattern that you see. You can see here the baby boomers most likely to purchase in their home country, perhaps having to do with their less frequent travel. Generation X then at 54% in their home country, and millennials being the lowest at 48%, most likely to travel and purchase abroad or in airports, as you can see. And then emerging markets and mature markets. You've got 59% in mature markets likely to purchase in their home country, and emerging markets much more likely then to purchase abroad or at airports. Now, this is an important analysis breakdown here of price differentials. You can see here in the emerging markets and Asian markets of China and Japan that the price is much higher relative to the European countries. And the European countries, of course, very, very important when it comes to personal luxury goods. Italy and France in particular, you can see there they have the lowest price in relative terms. A lot to do, of course, with the fact that they are produced and manufactured in those countries, and so export and distribution costs are lower, allowing them to charge lower prices. And then as you move outward, of course, the costs become higher as a result. Also, in places like China, you have a lot of import controls and tariffs, which then shoots up the prices even further. And this is what then motivates and spurs on both the consumer tourism and the tendency of the emerging markets to resort to more online purchases. And that's the explanation you can see there for those particular markets being more prone and more likely to go online to try and get the best deals and the best prices, to avoid the distribution costs, logistic costs that cause a markup, or the tariffs that are imposed by governments like the Chinese government. And so that's the motivation for the online push or the online surge in the emerging markets. So some general conclusions here this is from Bain & Company's analysis. From physical products to digital and experiential, this is one of the major trends here. The essence of luxury is changing from an emphasis on the physical to a focus on the experiential and how luxury makes you feel. So that was reflected in that survey that was done by Deloitte. You could see that the way that it makes you feel was number 2, and the emphasis on the physical aspect or the handmade aspect was number 3. So relatively speaking, the experiential is much more important. But of course, premium quality is still number 1, as was mentioned, and a must-have, and consumers still have a keen eye for craftsmanship as well and handmade products, and that was in at number 3. And we're moving from standardization to personalization. This is something we're going to see later on, particularly with the millennial generation. They're getting more and more discerning, and they're demanding more individualization in their products to demarcate and differentiate themselves from other consumers. So we're seeing this expansion through globalization. It has to strike a balance between that kind of scaling, which allows one company to distribute and mass produce, and also the ability to tailor their products to particular markets and indeed to particular demographics in terms of the millennials. So we're seeing a changing luxury shopper behavior, which demands different, more personalized responses. And this is a really big challenge for global luxury brands in particular, those who are looking to maintain a global presence and brand identity. How do they strike this balance? We'll come back to this later on, a really interesting strategic question. Now, I want to focus here in section 3 on this idea of accessible luxury. This is something that was mentioned in the pre-scene, and I want to dive into this a little bit more deeply to draw out some of the implications and the challenges of being within this strange kind of intermediate segment and how a company can deal with those challenges. You can see here, this is from a recent article. This is a really, really good article. We recommend it, and it's actually linked in the sources of the PowerPoint, which you will receive with this industry analysis. It says affordable luxury brands can be financial juggernauts, but does their accessible pricing and widespread distribution mean they have an inherently limited lifespan? So what does this mean exactly? Well, these kinds of companies, it seems, face a positioning dilemma, and this is explained here. As you can see, according to Darpizio, is an expert on this particular issue. Accessible luxury labels follow the same codes as true luxury brands, from stores in prestigious locations, high-end customer service, luxurious packaging. But what varies between the two is the pricing and positioning. Accessible luxury is a strategy used to create desire for products that are not super luxurious, but are affordable to a large audience. But as we can see here in this next passage, over the past few years, Michael Kors has expanded heavily and aggressively. The brand is currently available in 4,133 locations worldwide, up from 2,913 sites at the beginning of 2013. That's almost a doubling. In 2014, the label had 703 stores, up from 231 in 2011. That's more than a tripling. Kors products, in particular its handbags, have become ubiquitous. So you're seeing these more and more around on the street. More and more shoppers are, it seems, able to acquire these kinds of products. And this is resulting in the brand's luxury cachet, its luxury image, being diluted and compromised. So this is the real challenge here. These intermediate or accessible luxury products, they're positioning themselves at price points which are within the reach of, in particular, for example, millennial and younger consumers who want to have some kind of luxury experience but maybe can't afford just yet that really, really upper range, high-end luxury product. The problem is that this is kind of a paradoxical situation, because the more success a company has in this respect, the more likely it is that they're going to have large volumes of sales, because they're going to be appealing to a segment of the market which is not served at all, vastly underserved by the really, really high-end luxury labels. And what happens then, or what's in danger of happening, is that the more successful you become at striking that particular position, the more ubiquitous and widespread your products become, and the less they seem like luxury items. So this results in many different ways and many of dealing with this particular dilemma. There are many different companies, as we will see, who are positioning themselves more or less in this segment, this kind of accessible luxury area. And they've responded in different ways to this particular challenge. So as you can see on the left here, Michael Kors has responded to this oversaturation in established markets by announcing a shift to new markets overseas, like Japan and China. Revenue in Japan, it says here, climbed over 42% in the fourth quarter, with Japan only accounting for 1% of Michael Kors' total revenue. But the company plans to open 10 new stores in Japan this year. So it's not really clear how effective this kind of strategy will be. Certainly it has a natural limitation on it. It's kind of like a whack-a-mole game where you move to one country and Michael Kors will establish there. It'll expand in the same way it has done in other countries. And then it will have to move on from Japan as its luxury cachet gets compromised there. So the question is whether or not this is really a sustainable response from Michael Kors. Will they need to look at other strategies to combat this kind of dilemma that they're faced with after having oversaturated the markets in the more established or mature markets, where it had some success, considerable success, in the last 5 to 6 years, which is now beginning to wane, and we're seeing those sales begin to taper off as customers respond to the ubiquity of the product, and they're less likely to consider it a real luxury. On the right then, here you have Coach, another US brand specializing in luxury bags. They announced they would shut a fifth of mainline retail stores in North America, its biggest market, and offer fewer discounts. Under the new chief executive, Victor Lewis, who came on board in 2013, the label is turning to acquisitions to drive growth rather than expansion into new markets. So a really interesting turn here from Coach. They've actually decided to restrict their supply. So an interesting kind of move in the direction of the higher end luxury, whereas Michael Kors is kind of doubling down on their expansionary strategy. Coach, on the other hand, is realizing that perhaps it's not really sustainable to go that route, and they seem to be pulling back a little bit. Maybe what they're trying to do is create some artificial scarcity in order to drive up the kind of luxury perception of their brand, to drive up the perception that it's actually harder to come by, harder to obtain, and that this might in turn spur sales on again and reduce the perception that Coach is becoming a little bit too commonplace.